Welcome, everybody. My name is Stanley, and today we're going to be going over IAC's Q4 earnings, which they released yesterday on Valentine's Day. By the way, happy Valentine's, everybody. So, to everybody who is... Oh, log in? Oh, Jesus Christ. Give me a second. I just want to log in so I can see all your nice comments. Stanley.woo. Okay. Give me 1 second, guys. Okay. Oh, hello. Just getting used to the chat here. Let me try to type a message back. Oh, hello. Hi. Did that work? Oh, great. Awesome. Okay, enough me fooling around with everything. Let's get started. So today we're going to talk about IAC's Q4 earnings. Now, IAC released their Q4 earnings sometime on Valentine's Day, and the CEO made a joke about that during the call, and because he always had to do earnings calls on Valentine's Day, but it's quite nice earnings. Like if you look at the share price for IAC, let me just switch my screen over so you guys can see. Oh, oops. Adjust the camera a little bit. All right. Now, if you look at the share price for IAC, let me just see if I can show you guys what I'm talking about here. Is it this? Okay. Oh, Okay, there we go. Looks like my screen's sharing. Let me just move this down a little. Okay, just in my camera. All right, so if you look at what's going on with IAC after they released their earnings, you can see that, okay, they're down today, but if you look at what happened, it popped like around 9-10% since the earnings were released. So the market seems to have taken it as a pretty good thing that these earnings were released. Now, I think the earnings were actually pretty good. I am an IAC shareholder myself, so I am a little bit biased here. And by the way, none of this video should be financial advice. So, if I'm wrong, please don't sue me. Now, let's go over the earnings first. Now, before we get started, I just want to quickly jump through IAC as a company. Now, let me see. Our brands. There we go. What was that website that I saw? Hey, there we go. This is something that you guys can see. So IAC is basically... Oh, hi there. Hey, Digital Halo. Good to see you. So let me just give a quick background of IAC and what the hell IAC is. So IAC is a holding company. The two main components of IAC are Angie and Dotdash Meredith. Now, what the hell is Angie? You can see the logo over here that I'm displaying right now. Angie is a site that matches homeowners with handy people. So anytime somebody wants to do something like get their lawn mowed or get landscaping work done or get their wall painted, or if they have HVAC work or plumbing work that they need to get done at home, Angie is the place where a homeowner can go and do a service request and it matches it with somebody who can come do the work. Now, that's an alternative to these handy people having to set up their own website and their own digital marketing. So Angie's kind of that shortcut where if you want to build your business, and instead of going to set up and ask for referrals from people and ask your friends if they need work done, you can just go to Angie and get the business there. Now, what's going on with Angie, just a quick background, is Angie is going through a reboot right now because Angie historically has grown about 15-20% per year, but they were unprofitable and their losses were increasing each year. Now, if I were to show you guys just what the hell is happening, just go to Seek an Alpha here. And if you look at Angie, the historical trend of the financials, I don't know if you guys, you guys can see my screen. So basically, I don't have the paid version anymore, but you can see the revenue climbing, like 2019, 2020, 2021, 2022, and then boom, you can see 2023, it dropped like a ton. And of course, if you look at the net income, I mean, Angie never was really profitable. I mean, they had a brief profitable year in 2019, and then the losses just started narrowing. Started widening. You can see the losses go up significantly along with the revenue growth during that same time. So sometime around 2023, there was a huge change in the company that caused revenue to fall off a cliff. And it essentially made people really, where is that thing? It essentially made people really paranoid about IAC and about Angie. And the belief was that, oh, Angie's revenue is declining. What the hell's going on? It was going up for like years and years. And why is it going down now? It went down like significantly. I think it was like 30% or something. So people started panicking. And that's what was causing Angie stock price to drop so much and IAC stock price drop so much during 2023. So what I want to look at in the earnings today is how well IAC is doing their turnaround, because the problem with Angie, just a quick backstory for all you guys, is they were having some real trouble with retention. So I had a friend actually who worked for what was the company called? Homestars. Now, Homestars is like the Angie equivalent in Canada. And he was telling me how his job was literally to annoy the hell out of these service professionals by cold calling them repeatedly and asking them if they wanted to sign up for a Homestars subscription. And he was telling me there was a lot of complaints where a lot of the people he was calling didn't see much value in the subscription, and the leads that Homestars was giving them were actually quite bad. So the focus right now from the CEO is to actually prioritize the business around aspects of the business that are best for the customer experience. So he wants to get rid of all those unnecessary calls to these service professionals. He wants to re-optimize the business around profitable revenue, and he wants to make it so that instead of trying to just grow, because the basic idea with network effect businesses is you're trying to grow the amount of service professionals and you're trying to grow the amount of homeowners. So before, the strategy was just grow the homeowners at all costs and the service professionals at all costs. But that led to some unhappy homeowners and some unhappy service professionals. So the focus right now is anti-growth, which is any service professional that is not going to succeed on Angie, where we think they're not going to get the return out of their marketing spend, we're going to just let them go and find business elsewhere. The same with homeowners. If a homeowner isn't going to be happy on Angie, then we don't want the homeowner on our platform. So this is a very bold strategy, and I respect the leadership for going to that strategy a lot, because their strategy is, okay, let's forget about short-term growth here and let's just focus on creating a good experience. And then once we get all our operating metrics together and our brand is restored, then we can focus on more sustainable growth and we can grow profitably as well. And of course, investors, when they hear about anything related to short-term term declines for long term growth. Most of them are short term focused, which is what's causing Angie to sell off right now. But that's the turnaround that I want to focus on to see how well they executed in the recent quarter. Now, let's talk about another one of IAC's brands, with his Dotdash Meredith. So what the hell is Dotdash Meredith? Excuse me, my cat is just playing with playing with a toy there. It's making noise. So Dotdash Meredith, sorry, give me a sec. Sorry about that. So, what the hell is Dotdash Meredith? Well, you've probably not heard of Dotdash Meredith, but you've probably heard of some of these websites like All Recipes, Investopedia, People, Simply Recipes, Southern Living. So it's a collection of websites, and their main business model is marketing. If you've ever read a blog before, and the blog was like talking about food or something, or a recipe, and then like at the bottom it was like click here for like a 15% discount for HelloFresh or something like that. That's basically Dotdash Meredith's business model. They have a bunch of people write blog posts, they have a lot of loyal readers, and a lot of these people, these brands have been around for a really long time, and they pay thousands of people to go and actually try products themselves and then review it on these sites. So this is kind of like a advertising machine. And one thing that differentiates Dotdash Meredith from a lot of these other marketing avenues. So a lot of what distinguishes Dotdash Meredith from a lot of other companies is their brands are very focused on one topic. So, for example, if somebody's going on All Recipes, they're probably looking for a recipe. And anybody who's going on Investopedia is probably looking for some investment information. So each of these websites are very targeted towards a specific niche audience, which makes marketing them really easy because you don't have to use cookies. You don't have to go and violate people's privacy. If somebody's going on food and wine, you know exactly the kind of person they are. If they're going on Investopedia, you also have an idea of the kind of person they are. So that's Dotdash Meredith and the advantages that I see with this business. Now, the problem with Dotdash Meredith is the fact that there's a lot of temporary restructuring costs that are going on right now. So IAC previously owned Dotdash, which owned several of these brands, and they recently acquired Meredith for about $3 billion. Now, the problem with this is it led to a bunch of issues with integrating their platforms together, which also caused a bunch of shortfalls in SEO. And this is also tanking IAC stock price because when SEO falls, your marketing falls, you don't make as much money from your ads anymore, and the business became unprofitable for multiple quarters. So another thing we got to look at in these earnings is how well they're actually managing the turnaround for Dotdash Meredith. So enough preamble now. Let's actually go into the results. So I went over the results. The results are actually pretty good. And there are some good parts and there's some bad parts, but I would say mostly good parts. The highlights of the earning for me is Dotdash Meredith. This did a huge turnaround. So Dotdash Meredith was experiencing revenue declines and earnings declines for multiple quarters now. And now we can see that the digital revenue is ticking up. So it ticked up to 9% growth year over year. And even though they reported a loss, the loss was because of the amortization of intangible assets, which, I'm not an accountant. I don't know what the hell that is, but in a nutshell, it's basically like depreciation of intangible assets. So if you have like a website and the website gets less valuable over time, then you amortize that cost over like a set period of time. Basically, it's not important. It's basically something that's not going to recur once the restructuring is finished. But if you take out that amortization of intangible assets, the EBITDA actually grew 69%, nice, 69% to $124 million. And that includes a $21 million restructuring charge. So if you take out that 21 million restructuring charge, which probably isn't going to be recurring, the adjusted EBITDA actually was about 145 million in one quarter, which is really good. And that's a huge turnaround from Dotdash Meredith just making losses for multiple quarters. I think it's very, very promising. If you think about their ability to continue this trend, and let's just say they generate about 140, 150 million in EBITDA each quarter. Well, that's about 600 million in EBITDA every year, which is like a lot of money. This is going to be a cash flow machine. And the one thing that I really like about Dotdash Meredith is the fact that because it's an advertising business, there might be some upfront costs for restructuring everything. But once everything's restructured, you don't, like, a lot of the incremental revenue that you're generating is just going to be pure profit. I think they did a study here in the recent earnings call where they said that incremental revenue translated 90% to EBITDA, which means that, like, once you have your upfront restructuring costs finished and the traffic starts to pick up again, additional revenue that's generated from increased traffic is just all gonna go towards the bottom line, which this earnings has really improved my opinion of their acquisition of Dotdash Meredith. Now, moving on to Angie. Now, Angie, I would say is not as rosy as Dotdash Meredith. The revenue was 300 million. Revenue declined 16%, which I think everybody was expecting. Some of that revenue decline was because of how they recognize their services. So basically, Angie has this division where they match a homeowner with a service provider, and they essentially make a little bit of profit as the middle person. So let's just say Karen wants to get her lawn mowed, right? So Karen is willing to pay $800. Angie pays $600 to the service provider and pockets a profit of $200. So before, Angie used to recognize the $800 as their revenue, but now they're recognizing the $200. So they're recognizing the net revenue that they're getting from that transaction. Basically, it means that because of this way of actually recognizing the revenue for services, it caused a pretty big decline. But that wasn't the only thing. The revenue also declined as a result of less service requests and lower service professionals on the platform. And that is, again, they're stressing the focus on profitability and customer experience. So they actually are exiting a lot of services. So any complex service, which is very difficult to estimate, which often results in losses for Angie, they're exiting that completely. They sold this total home roofing business, which I imagine also had something to do with the revenue declining because, Angie tried to do something that is outside of their core business model, which is matching homeowners and service professionals. And they tried to go into the roofing business, which I thought was pretty dumb. And I think the CEO also thinks it's pretty dumb because he sold the roofing business. He bought it for, I think, like 20 or 25 million, and he didn't disclose the price he sold it at, but even if he sold it for a small loss, I don't think it's that big of a deal. And it looks like they broke even on Angie. The operating income was about 8 million, but it included an 11 million benefit related to insurance coverage. So they made a small loss if we discount this 11 million benefit. But the suggested EBITDA grew 96% to $41 million. So it's encouraging. I think Angie is definitely going in the right direction here, although it's still experiencing revenue declines, even if earnings is growing, which means that the stock price in the short term, at least the next year, is probably going to still remain pretty low, I would say, although higher than it was maybe last year because they are showing that improvement in the earnings. Let's see, comment from Digital Halo also. Chatbots like ChatGPT copying recipes without giving credit to Dotdash Meredith takes away from their views and therefore their revenue. Yeah, absolutely agree with that. However, the CEO mentioned this in one of the earnings calls, which is he was going to have ongoing discussions with Microsoft and Google about the ability for ChatGPT to just be able to just steal information from people in writing their answers. If more people are going on to ChatGPT versus these, let's just say, other sites that Dotdash Meredith owns, it could definitely hurt their business. One of the things that the CEO said was that they were going to actually try to get regulation passed from the government, where if ChatGPT takes any information from any of Dotdash Meredith's sites, that they were going to have to pay Dotdash Meredith, or that they wouldn't be allowed to use the information unless they were paying something. And I think it doesn't just apply to Dotdash Meredith, but pretty much every single site that writes articles. Because if you think about it, there's no point in writing an article if ChatGPT can just jack the information and provide it for free for users. So I think this is an issue that affects the entire publishing space, and the CEO is going to work with these guys in order to try to get legislation passed to stop ChatGPT from stealing intellectual property, because that is essentially what it is. It's stealing intellectual property. Another thing, though, that might insulate Dotdash Meredith from ChatGPT is we have the traditionalists, people who, don't really like AI and who say that they trust an opinion from a person rather than a machine. Like, for example, me personally, when I go on ChatGPT, I always cross-reference it with something else because I don't know where that information's coming from. And ChatGPT is right, and a lot of the times it's not a complete answer. While Dotdash Meredith has the benefit of having lots of loyal readers on each individual site that they have. And another benefit is they have real people reviewing these products. So, for example, if it's like All Recipes, it's somebody who actually used the recipe, made something, tried the food, and then wrote something. And because they have thousands of people actually trying products themselves and writing articles, that creates more of like an emotional connection with the reader, where even if they can get the info from ChatGPT, they still rather get it from the site itself, because both are technically free, and also they've been doing something for a while, so there's inertia there, but also there's that human connection and trust that comes from somebody who's actually writing it, as opposed to just who knows what the hell where the AI got the information from. Yeah, God bless if they need to get regulation done, because it's not just Dotdash Meredith who's suffering from this. Just the entire blogging space is going to suffer as a result if people just stop reading blogs, stop reading articles, and just search everything up using AI. I think that's probably not good for the society in general. But that's I guess another point. So hopefully that answered your question. Let's move on to emerging and other. So what is emerging and other? It's basically all the other sites that IAC has. If you look at their brands, we might be able to see some of them over here. So we have Care, Daily Beast, and Vivian. These are probably their most valuable emerging and other brands. They also have Search, which Search sucks. Like, don't even get me started. Anyway, so what happened in emerging other? So revenue decreased 28%. Now, before start panicking over that, it was as a result of multiple sales and businesses. So they sold the roofing business. They sold Blue Crew for about 130 million. This was a loss-making company. And they also sold this company called Mosaic Group, which is like a collection of apps. I don't actually know what it does, but evidently management also doesn't know what it does also, so they sold it. But that resulted in revenue going down, but the operating income increasing, which makes sense. If you sell a bunch of companies that don't make much money, that'll cause the revenue to go down, but the earnings to increase because a lot of these companies were loss making. 25% growth from Vivian Health is really healthy. Vivian Health is this site that they have. They don't talk about it too much, but it basically matches nurses with hospitals and places that need nurses, which is growing a lot because nurses, of course, always need work. And hospitals, there's a huge shortage of nurses right now, so they need some place to be able to hire these people on short notice. So Vivian Health is, and it was said in the earnings call as well, it's one of their most promising assets. And we have 2% growth from Care.com, which is pretty underwhelming. I don't think their focus right now is on Care.com. This company, since it was acquired in 2020, was growing at about 20-30% each year. Although, the losses have been narrowing, but at some point, management says Care.com is going to contribute more to growth. And here we see IAC saying that in January 10th, they sold Mosaic Group to Bending Spoons for about $160 million, which is good. You want to sell some of your non-performing assets, some assets that are less well-known, to get extra cash on the balance sheet to then invest into your other core businesses. Because let's be honest here, like Mosaic Group, like how much does this actually contribute to IAC's valuation? I don't think it does at all. So it's better to get the $160 million in cash because investors don't even care about this company. All right, MGM Resorts. This is pretty huge. So in 2020, IAC invested about $1.3 billion into MGM. Now, MGM it's like this Las Vegas resorts, casino gambling. They also have like huge stadiums that host events. So during COVID, a lot of panic selling. I can imagine why, because nobody's going to these events, and of course, online events can only take you so far. But as we know, COVID is now hopefully well behind us, although there's still some COVID cases here and there. But MGM reopened and started making tons of money. And around 2020, IAC made the decision that, even though it was going through some temporary COVID headwinds, let's go get in there and buy the cheap company. And then everything reopened. MGM started making tons of money, and it's now worth $3 billion, partly as a result of investors being more optimistic about the company because COVID is gone, or mostly gone. Fingers crossed. And also because they bought back 1/3 of their shares outstanding. So originally, I think IAC bought a 12 or 13% stake. Stake is now worth about 20% and worth $3 billion. So I think this is a really good use of capital. All right, quick summary of everything that happened. So here we can see revenue from Dotdash Meredith was flat. The reason it was flat is because of print revenue. So Dotdash Meredith has the digital side and they have their magazines. Now, I don't know. Do you guys know anybody who reads magazines? that business is declining like 12% each year, and management said it's going to continue to decline. Although it's also generating earnings, or just mild earnings / break even, because they're trying to focus on the magazine subscriptions that have the most loyal following. So maybe have 50-year-old women who have these magazine subscriptions that they insist on reading. So Dotdash is trying to focus on those magazine subscriptions with the core, most loyal subscribers. But of course, revenue decline from the print is going to offset the digital. Here we have Angie, which showed a 27% decline in revenue, but some of this was related to how they recognize their services, from recognizing the gross amount to recognizing the net. Search, Search, I wish they would just hurry up and sell their freaking search business, because Ask.com, maybe it was big in the 2000s, but I can't imagine anybody using Ask.com these days. I suppose you have maybe some loyal users, otherwise why the hell would they keep the business? They say that it generates a lot of free cash flow, which I imagine it doesn't sound like a very capital intensive business, but I think they should sell this. God damn it. And they have emerging and other. The revenue declined a ton, but that was as a result of selling a few of their businesses, which I mentioned already. Operating loss, Dotdash Meredith showed a loss of $18.1 million, but that was due to amortization of intangibles. So essentially intangible assets depreciating. If we take this out, it's actually quite profitable. As we looked at, the EBITDA was like, 140 million or so if you take out one-time charges. Angie showed a mild profit. Search, the net income went down. Emerging and other actually showed a mild profit as a result of selling off some unprofitable business units, and corporate expenses increased. That's another thing. If you invest in IAC, you have to be aware that there's a lot of stock-based compensation going on. So the corporate expenses are pretty high, which is my gripe with IAC. But, if Joey Levine is doing what he's supposed to do and turning around these businesses, I guess it's kind of a drop in the bucket compared to how much the assets will increase as a result of his leadership. Here we have adjusted EBITDA. Dotdash Meredith can see massive growth, 69%. Nice. We got Angie, another pretty significant growth in earnings as a cost of revenue. Search is also declining, and emerging and other is increasing. I think most of this is probably due to Vivian Health and Care. And so overall, they reported a pretty significant increase in adjusted EBITDA, about a 57% increase. So I think overall, the earnings are good. Now, let's look at some in-depth breakdowns into what's going on in Dotdash Meredith. You've got another question. Who's going to buy it, though? Yeah, I don't know. Find a venture capitalist company that just has billions of dollars to throw around and be like, hey, you know what? Maybe this can be a competitor to Google. I think management is probably just thinking, let me just sit on this Ask thing, and hopefully it turns around and we'll just milk as much cash as we can from it. Well, in the meantime, I think that's probably the strategy. All right, what's going on with Dotdash Meredith? So digital growth improved 9%. This is really encouraging, because when Dotdash and Meredith merged, they had problems with SEO, and that caused the search engine optimization stuff to decline. And rest in peace, the digital revenue was falling a lot, which was spooky investors. The good news is it looks like the restructuring is working, and the digital revenue is also going up, and the ad market is also improved, probably as a result of just perceptions of the economy that it's doing better or something like that. So we can see ad revenue increased 4%, an improvement from a 12% decline in Q3. God bless. Higher programming advertising revenue due to higher traffic. Well, that's great. They break down Dotdash Meredith's different websites, and core basically refers to the websites that they think shows the most promise, and that went up 10%, which is really encouraging. And it seems like they sold more ads on the beauty, travel, and technology sectors. Performance marketing revenue increased 31%. That's something that is really significant. Performance revenue is basically like if you go on a website and you go on All Recipes, and let's just say All Recipes is selling you a subscription to Good Food or something. And if you go and decide to you decide to go and sign up for a good food subscription, then the website All Recipes and Dotdash Meredith, as a consequence, gets a cut of the purchase of good food. So that's an example of performance marketing, and it went up 31%. And this is something that makes me super optimistic about Dotdash Meredith, because ultimately, what incentivizes advertisers to actually spend money on an ad platform is just how much return they're getting from it. And performance marketing is probably, in my opinion, one of like the most looked at things that you need to evaluate whether or not an ad platform is successful, because it's directly translating to sales. And that just goes to show that a lot of Dotdash Meredith's readers are very loyal to the platform, and they make decisions based on what the writers on Dotdash Meredith recommend. You can see here 54% affiliate commerce growth. A lot of this is driven by Amazon. So Dotdash Meredith actually has a partnership with Amazon, whereby Amazon can put their ads on Dotdash Meredith websites. And of course, if somebody wants to buy, like, let's just say like a slow cooker or something, they can just click the ad and make the purchase on Amazon. So a lot of that affiliate commerce growth is also driven by the Amazon partnership. And they're also talking about partnering up with Google as well, which makes me really excited about this digital growth. As we can see, print revenues went down 12% because of reduction in circulation of certain publications. So that makes sense. Focus on the magazines that have the most loyal viewers and get rid of the non-profitable magazines. And we can look at here. So digital had a small loss, it looks like, probably as a result of these one-time intangibles. It goes through it here where it says this loss was because of 75.9 million higher amortization of intangibles due to a 80 million impairment of certain indefinite lived assets. So basically, Dotdash Meredith had a bunch of sites that were that just kind of sucked, and management looked at the sites and were like, "You're actually worthless." And then they went into their accountant and was like, "Write off this asset." So then the accountant does what they do best and amortize the intangible, which cancels out a lot of the income and results in a mild loss. But this isn't actually like a real loss; it's just a write down of an intangible asset. And adjusted EBITDA went up a lot, which we talked about was very encouraging. And on the print side, they had operating income of 1.2 million compared to a loss of 23.3 million. Man, that's huge. Like, you go from losing like 23 million per quarter to actually making a mild gain is pretty good. And this EBITDA increasing was due to lowering operating expenses resulting from the reduction of planned circulation of publications, which is exactly what I talked about. And it looked like there was also a $19.8 million amortization of intangibles charge that went into this print operating income, which is very encouraging, because at some point their management is going to stop writing off these intangible, like the intangible factor, like these magazines that aren't generating much return. And once they write off all of that stuff, you don't have these amortization of intangible charges again, and the operating income is going to go up as a result. And other operating losses, well, see, you have higher stock-based compensation, which is something what I talked about with IAC. I don't like this part of the business. And adjusted EBITDA decreased due to lower operating expenses and $2 million restructuring charges. So they're still incurring restructuring charges, but this is going to go away once the process to integrate Dotdash and Meredith is completed. And yeah, well, what can I say? Some of this is as a result of just IAC cutting spending and cutting capital investments. All right, what happened to Angie? Well, let's look at the 2023 earnings release here. So let's just go over some details. So revenue decline, I already talked about that. Earnings increased as a result of the focus on more profitable revenue and the focus on user experiences. The transacting service professionals were down 11%, although increasing from the 17% declines in Q3 2023. So service professionals on Angie are going to continue to decline because you have some service professionals who can succeed on the Angie platform. They get leads, they call the leads, they book their meetings, they go and show up, and they do really well. They make money from the platform. Oftentimes, service professionals that are more established are better at succeeding on Angie because they're able to allocate a portion of their resources to Angie so it doesn't make up their entire revenue. And they also have like an infrastructure where maybe somebody goes and calls the homeowner, books the meeting, and then the service professional shows up. Or service professionals that are just good at sales because that's important. If you're just a service professional and just wants to mow the lawn and call it a day, or do the plumbing work and then call it a day, and you have no sales experience, you're not going to succeed on Angie. So right now, what they're prioritizing is let's just like make it so that the service professionals who can actually succeed on the platform stay with us, and we tell the other people who can't succeed to go just find somewhere else to do the work. And so that explains why it's down 11%. Cash flow increased, which is really good. They're lowering their capital expenditures, which is good. It seems like what they're focusing on is the core business of Angie, which is matching service professionals with homeowners and making that experience as positive as possible, and reducing their focus on other things that maybe cost money but don't help with that goal. Angie also repurchased shares, so they bought back 6.1 million shares, and they're going to continue to buy shares because I think they authorized about 20 or 25 million into share buybacks, which is always good to see because they're seeing that their business is cheap right now and they want to buy back shares. And Angie completed the sale of Total Home Roofing, which is good. You know, I don't know why you wanted to get into the roofing business in the first place, but it's a good thing that they're out. And for full year 2024, they expect either a small loss or a mild profit on Angie, which is pretty significant. I mean, if you look at Angie's history, like other than for that like 1 year when they made some money, they were losing $128 million in 2022. So to go from losing $128 million to maybe losing $20 million and making a small profit, I think is like is huge progress. I mean, it doesn't look pretty because the revenue is going down, but the business is getting better. Okay, so let's take a look at revenue. So ads and leads went down. That's because Angie right now is trying to focus more on having better ads and better leads for the service professionals. Where before, if you ever look at like Home Advisor's reviews, they had a lot of complaints from service professionals saying that the leads that you're giving us are garbage, and a lot of the times it's like fake names and stuff. So Angie is trying to improve this where they're sending out less leads, but the leads are much better, which is going to cause negative growth in the near term. But over time, it's going to lead to better user experience, hopefully more referrals, hopefully more people organically coming to use Angie. Services went down a lot, partly because, I mean, it explains it here. They're trying to exit complex services and reduce the amount of service requests. So they're focusing on generating service requests that are most likely to generate profit, and they're exiting these complex services because they're difficult to estimate. And if Angie is saying to the homeowner that it's like, let's just say, $900 for you to do this service, and then the homeowner goes talks to the contractor, and the contractor's like, actually this service is a lot more complicated than we thought, I'm gonna have to charge you $1,100. And then the homeowner goes to Angie and is like, what the hell, I said 900. And then Angie will be like, okay fine, 900, but they'll have to pay the service professional $1,100, so they make a loss on it. So that's why they're exiting complex services. International revenue is actually very, very attractive. Looks like it went up 21%. And the international part of the business for Angie is what they're trying to get to for the US, because international is their business runs mostly on self-enroll. So you have majority of service professionals. You don't have to like cold call them to sell them any marketing. The service professionals like the service so much that they self-enroll to it, which saves you a bunch of sales and administrative costs. And the matching for homeowners and service professionals is a lot more efficient on the service revenue on these international sites. So there's less friction in a homeowner getting matched up with a service professional, and the service that's being performed is most likely going to be profitable for Angie. While the US side is the exact opposite. You have a lot of people trying to cold call these homeowners in order to try to get them to sign up. Sorry, not cold call homeowners, but maybe that's some of that as well. But they're cold calling these service professionals to try to get them on the site, to try to sell them a marketing package. And that creates a lot of upfront costs. And IAC is trying to reduce the sales force on the US side, so it's more service professionals enrolling themselves on Angie. And for you to do that, the user experience needs to be good. So they're using international as like this kind of role model because they've already accomplished it internationally. They want to take what they've done internationally and apply it to the US part of their business. All right, let's take a look at losses. So it looks like there's some small earnings decline from ads and leads, which is understandable because if you're trying to prioritize the quality of service professionals, then you're going to get less ads and leads revenue because you're sending out less leads to your service professionals. Services losses narrowed a lot because they exited the complex services, and you have these corporate expenses which seem pretty normal. And as a result of these efficiency changes, mostly to services, it looks like the earnings went up a little bit for domestic. It definitely broke even, which is a big change from losing $28.7 million. International grew as well as a result of just overall positive growth in service requests as well as service professionals on the site, because international has that stronger brand as well as stronger user experience. And overall, they made a little bit of a profit, and they made some good profit on adjusted EBITDA as well. We can see the breakdown over here. Again, earnings went down, earnings went up, revenues went down because they're focused on lower sales and marketing, improving unit economics, exiting complex services, and they also had a restructuring charge of $13 million, which is good because this is not going to be recurring, which means that for the next quarters, the earnings are going to be higher because of the non-recurring $13 million legal charge, which affected them this quarter. Okay, lower stock-based compensation, which is good, lower depreciation, and here we can see international went up a lot because of, selling and marketing, general and administrative expenses going down, and an increase in revenue because that section of the business is growing. All right, yeah, I think that's it for Angie. Now, let's go into search. Now, search is pretty straightforward. The business sucks. It looks like they incurred a 14% decrease in the Ask Media group because of fewer visitors. That makes sense. I mean, there's going to be less and less visitors to Ask Media as Google and possibly Bing increase their service offering. And this desktop business is basically just a legacy business that's kind of useless. So I would say with search, just, look the other way. Hopefully they milk as much money from this as possible. Well, moving on to emerging and other. Kind of what I told you already, they sold a bunch of non-performing businesses in order to get money, and that resulted in losses narrowing as a result of unprofitable businesses being sold, and revenue declined as a result. All right, so overall, I would say these earnings are actually quite good. let's take a look at the shareholder letter, which is what Joey Levine is writing for this year. So let's get started. Feels nice to say for the first time in a while that the year finished stronger than we hoped. Our three biggest consolidated businesses, Dotdash Meredith, AngieCare.com, all generated healthy profit, and our minority investments, MGM and Turo, generated record fourth quarter revenues again. The back to basics theme for 2023 largely worked. We got the synergies going at Dotdash Meredith and cleaned up the P&L at Angie, lifting IAC's cash flow and adjusted EBITDA materially. Work is never done, but what a difference a year makes. So if you look at IAC's cash flow, you can take a look at their cash flow statement. The cash flow, which is cash from operating activities, has been pretty low leading up to 2023. And 2023, it looks like they made a lot of progress in terms of getting that cash flow to be positive. Here it's just talking about how their market capitalization is still, they can still consider themselves undervalued. And I crunched the numbers on IAC over here, and right now, they have a slightly lower net cash position as a result of IAC going out and buying the land that they live under. So slightly lower cash. Their long-term debt is roughly the same. So doing the number crunching, I think IAC is still about 45% undervalued, and the majority of their value that's attributed to their valuation right now is just their publicly owned assets. So Angie and MGM make up most of how much IAC is priced at today, without looking at any of these other assets like Care.com, Dotdash Meredith, Turo, to a lesser extent Ask and Vivian Health. Here it says, talks about their MGM investment, which I think is really good. Here you can say they mentioned that they bought back 35% of their shares outstanding, so their ownership is now close to 20% at the end of 2023. That's an investment that went from $1.3 billion to $3 billion, which is almost a 3x. I think this was a really good decision to buy MGM in 2020. Here it talks about Dotdash Meredith, and here you look at the core sessions and total sessions where it shows the traffic. And the traffic for the core sites, as you can see, has been declining for multiple quarters, but in Q3 and Q4, it ticked up. So traffic was up 5%, and now traffic's up 10%. And this is a really encouraging sign, because, higher traffic means higher revenue, higher profits for a lot of these Dotdash Meredith assets. So this is very encouraging to see, and if this trend continues, we can see this company really becoming a cash flow machine. Here it talks about their core sites, which comprise 80% of the total traffic. That's their main focus, and this is what's growing. And it even looks like for these other for total, the losses in traffic are also narrowing, which is also really good to see. They're talking about the ad market improving, as well as the performance marketing growth, which I mentioned is a really good sign for the business, because it shows that people trust the sites a lot and they're willing to make purchases after going and reading a bunch of articles because they trust the recommendations. Here they're talking about cookies. Now, the good thing about IAC is with these assets, they don't need to rely on cookies because they have targeted messaging. So they don't need to rely on this, which is great. This is talking about Decipher, which is basically this marketing tool that they're rolling out, where if somebody wants to advertise a certain product, they would run that ad through Decipher, and Decipher would automatically figure out which site that ad would be best for, and it would then place that ad on the most optimal site. So this is what they're rolling out as a competitor to somebody using, let's just say, Google Ads or Facebook ads, and it's it's really effective because it targets based on intent. So depending on what kind of product you're advertising for, it'll pick the best website. So if you're trying to advertise, let's just say a pressure cooker, it might put the ad on All Recipes because people who read All Recipes are people who are really happy and enthusiastic about cooking. And here it's talking about how Decipher is doing really well. It outperforms cookie-based targeting. And they're also talking about the partnership with Amazon Publishing Cloud, which is, again, the initiative whereby they can integrate the Amazon ads onto their website, and then the user can just click that ad and make a purchase using Amazon. And they're also talking about partnering with Google as well. And they're talking about the strong EBITDA growth, which I've talked about already, and that 90% of incremental revenue in the quarter showed up as adjusted EBITDA. And I think this is a trend that's going to continue because once you have the upfront costs for your investments in the Dotdash Meredith platform, any additional revenue generating from higher traffic is just going to go onto the bottom line. Now here they talk about Angie. They still have progress to make, but their main focus is on service professional retention. And here you can see that they're mentioning that service professional retention actually is up 20%, which is higher, up 20% from the numbers they shared in Q2. So their focus, instead of bringing on more service professionals, is making sure that the contractors who are going on to Angie are happy and they're choosing to stay with the platform, which it looks like they're making some good progress there. They're also talking about improving their marketing spend. So they're trying to make it so that less one service request can generate more monetized transactions. So a service request is like a homeowner wanting a job to be finished, and a monetized transaction is the work actually got completed, the money got sent through the Angie platform. So they're talking about how when service requests went down 29%, the monetized transactions declined only 9%. Now, even though both declined, what they're trying to get at is their business is getting more efficient so that it takes less service requests to generate the same amount of monetized transactions, which again is their plan to be more efficient, to improve how service professionals are being matched with owners, and to improve the amount of business that's taking place on their platform. And here it's talking about how they're presenting jobs to more homeowners. So that's always encouraging. And we know top line growth is a key milestone. True health in the business won't be declared until users and revenue are growing. So here it's talking about how they anticipate Angie to continue to decline in terms of their revenue, but they are improving the user experience. 2023 is going to be a year where they're increasing their earnings, improving the efficiency of the business, and then 2025 is probably when they're going to be looking to continue to grow the business again. So depending on how sophisticated investors are, I think 2024 maybe Angie might rise a little bit depending on how much progress they're making in terms of getting their earnings back on track. And then when the revenue starts to increase again and earnings start to increase as a result, I think Angie's going to pop in terms of its valuation. So here they're talking about their back to basics, which is to focus less on the non-essential parts of the business and to focus on what makes each of their acquisitions great. And they expect Dotdash Meredith to be their main cash flow engine, which Dotdash Meredith actually holds most of IAC's debt of about $1.4 billion. So their goal is to have Dotdash Meredith be that cash flow machine to then delever the business to pay off some of that debt. And eventually, I think they're going to spin out or make Dotdash Meredith public, which is going to be a huge tailwind for any IAC shareholders. And they're trying to get cash flow with Angie to be better as well, although their focus continues to be customer satisfaction and growing profits. All right, so overall, I think it was a good set of earnings. For a full year 2024, they anticipate most of their earnings to come from Dotdash Meredith, Angie to generate a little bit of EBITDA as well, although Angie, compared to Dotdash Meredith, I think is going to have more depreciation costs. I mean, Dotdash Meredith might have some more like amortization of intangibles, but I think that's going to go away at some point. Search is, let's not talk about search, but it's going to generate some money, which is good. And they expect corporate expenses to be around $100 to $90 million. And stock-based compensation is pretty high, but overall they anticipate that in 2024 they're going to either make a loss of $80 million to a slight profit of $50 million, which is, I think, good progress because they are narrowing the losses. I still think IAC has to do a bunch of work before they're able to get back to, let's just say, being a 2 or 3x investment. But I think 2024 is going to be that year where they set the foundation, and then hopefully early 2025 is when we're going to see some real progress here. All right. Well, thank you so much for tuning in to this review of IAC's earnings. I'm pretty optimistic as a shareholder. I think they made a lot of good progress, specifically around Dotdash Meredith. I can totally see that site becoming super successful over time as an investment for IAC. And I think 2024 is going to be a year where Dotdash Meredith really starts to tick up significantly as they get the integration properly done and as they see improvements in traffic, although it's hard to predict that because of the ad market. I mean, if we have a recession, it's going to affect Dotdash Meredith, but I think barring any major recessions or anything like that, I think Dotdash Meredith is definitely trending in the right direction. Angie, it's probably going to be more of a year of just fixing it and making it more efficient, setting it up for growth in 2025. And I think with search, just milk the cash out of this and try to sell it, I would say. And with emerging and other, I think Vivian Health and Care.com continue to be very promising assets for IAC. So overall, I think still quite a good buy. It's still trading at a big discount to their total assets. And I also anticipate that both Angie and Dotdash Meredith are going to become more valuable over the next year, which is going to cause the share price for IAC to see some of that as well. Okay, well, thanks for tuning in to this earnings review. My name is Stanley, and all the best to your investing journeys. Hope your stocks all do well. And